You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast.
We are looking at a really complex market balancing act today.
Yeah, you have the dollar, which is trying to steady itself after some pretty sharp losses.
And at the same time, all this speculation is swirling around the next Federal Reserve chair.
Right.
And, there are these warnings against a politically influenced push for rate cuts, and that's injecting some fundamental uncertainty.
Meanwhile, on the other side of things, commodities are giving much clearer signals. I mean, copper is just extending this record-setting rally.
Absolutely. Fueled by globally tightening supply and, major warehouse withdrawals. The bigger picture here, though, is technology trade policy.
Okay.
We're going to break down the latest signals from Washington about potentially easing export restrictions for NVIDIA's high-end chips to China.
And we'll also connect the dots between the fluid geopolitical landscape, the inconclusive U.S.-Russia talks on Ukraine, shifts in the U.S.-Venezuela dialogue and what that all means for oil markets, and just the overall risk tone.
So tune in as we dissect these crucial dynamics. They're influencing foreign exchange, trade, and commodity flows right across the globe.
Here's what you need to know.
So where should we start?
Let's start with the central nervous system of global finance, the foreign exchange market. The U.S. dollar index has been, desperately trying to stabilize. What's the fundamental driver here beyond the data?
It's the political risk. It's hovering directly over the independence of the Federal Reserve.
Okay.
The whole conversation has been seized by speculation about potential leadership changes in 2026, specifically, the possibility of certain candidates taking that top role.
So we're talking about the prospect of a politically influenced monetary policy, is that right?
Precisely. The market is getting more and more vocal about this perceived political interference.
And the fear isn't just who might lead the Federal Reserve, but why they'd be chosen.
Exactly. Bond investors, in particular, have reportedly been warning the Treasury against any selection that even suggests a deliberate, politically motivated push toward premature rate cuts.
That is just so critical, because if the market starts to believe that the central bank's hand might be forced toward easing, even if inflation is still sticky or the economy doesn't really warrant it, that just fundamentally undermines the central bank's credibility.
And that credibility premium is exactly what supports the dollar as the global reserve currency.
Right.
The perceived erosion of that independence, it just puts a ceiling on any dollar appreciation, no matter how good the incoming economic data is.
So the dollar struggles to recover because of this foundational uncertainty.
That's it. It's this persistent question about the integrity of future monetary policy.
And we really saw this play out in the dollar-yen pair, didn't we? It had that brief moment of strength, bouncing off the 155 level.
It did, yeah. Supported by equity markets for a moment. But that strength just reversed so quickly.
What happened there?
Well, that reversal tells a fascinating story about the shifting dynamics in Japan. The move was triggered by persistent hawkish signals coming from quarters close to the Bank of Japan.
Hawkish signals suggesting what? A rate hike.
That the window for a rate hike isn't just open, but that a move could come as early as December.
Wow. Historically, the Bank of Japan has been extremely cautious, always facing political headwinds on tightening. What's changed?
What's fascinating is the alleged willingness of the Japanese government to actually tolerate such a move.
Really?
For years, the government prioritized domestic financial stability above everything else. The fact that they're reportedly prepared to accept a rate hike, it reinforces the market's belief that this profound long-term shift away from ultra-loose policy is really happening.
And that provides a structural headwind against the dollar's strength versus the yen.
A sustained one, even if it's temporary.
Okay, so meanwhile, the euro seems remarkably resilient through all this. The euro-dollar pair has really held its ground.
It has. It benefited a lot from that earlier broad dollar softness, the one stemming from the Fed uncertainty. And European central bank officials, like Christine Lagarde, have been very consistent in their messaging. They're cautiously acknowledging that European labor markets are still resilient.
But they're not committing to anything.
Not at all. They are meticulously avoiding any rigid forward guidance. They want to keep their policy options fully open, especially with global trade dynamics being so volatile.
And what about the pound? Cable had a bit of excitement yesterday.
It did. It eased a bit today, paring back some of that impressive surge we saw. That move was fueled by some unexpectedly strong UK services PMI figures.
Which gave a boost of confidence to risk-on currencies.
Exactly. But as the dollar fights to find a floor, those gains are just harder to maintain. It shows that momentum really requires continued positive data surprises.
So currency stability is basically tethered to political uncertainty right now. Let's pivot from that to the, well, near certainty we're seeing in industrial demand, specifically in commodities. Copper has been the undisputed champion here.
It is the standout macro story. Copper's record-setting rally, it isn't just a headline. It's a really powerful signal.
And what's driving it?
We're seeing this strong confluence of short-term scarcity and long-term structural demand.
Okay, structural demand. So is this rally different from previous cycles that were just fueled by, say, a Chinese infrastructure boom?
That is the key insight.
Yes.
While tightening global supply is an immediate factor.
Right, from operational issues and lack of investment.
The bigger picture is electrification and the energy transition. Copper is fundamental to everything. Electric vehicles, renewable energy grids, you name it.
So that structural demand provides a foundation that makes this rally less vulnerable to a simple cyclical downturn.
Precisely.
And the specific data point that's supporting this immediate demand is inventory behavior, right?
Exactly. We are seeing a very distinct rise in warehouse withdrawals across the major exchanges.
So this isn't just money flowing into futures contracts.
No, this is actual physical removal of the metal from storage. It signals immediate industrial consumption and really robust on-the-ground demand pressure.
Geographically, is this a Western thing or is it global?
It's entirely global, which just reinforces the structural nature of the whole surge.
Yeah.
Shanghai futures are mirroring the strength perfectly.
So when you see both Western and Asian hubs showing physical withdrawal and price appreciation at the same time,
It confirms the rally is fundamentally underpinned across all the major industrial centers, regardless of what their regional economic momentum looks like.
okay, let's move to the energy complex. Oil market seems supported, but, well, cautious. There's a definite underlying bid. What's the diplomatic uncertainty sustaining the risk premium in crude?
It's the fluidity of geopolitics in Eastern Europe. Both West Texas Intermediate and Brent crude are grinding higher because those recent high-level talks between U.S. and Russian officials on Ukraine were inconclusive.
Right, President Trump called the meeting reasonably good, but that didn't really translate into anything concrete.
Not at all. There's no visible path to de-escalation.
So the lack of a breakthrough means the market just cannot price out the risk of a supply disruption.
That's absolutely correct. That sustained uncertainty keeps the risk premium firmly baked into the price of crude.
And the diplomacy is still moving.
Very actively, but unpredictably. U.S. envoys are now scheduled to meet with Ukrainian officials in Miami. Oil traders hate uncertainty, and this provides plenty of it.
So if oil is reacting to that, where does that leave gold? It seems kind of caught in a tug-of-war.
It is. Gold is just oscillating around that $4,200 an ounce level, and it's struggling to find any clear direction.
Why is that?
Because it's weighing two perfectly balanced opposing forces. On one hand, you have the dollar stabilization we discussed, which usually pressures gold.
And on the other?
On the other, you have the persistent, systemic interest rate uncertainty coming from all the Federal Reserve Chair speculation.
And political instability and lower real rates are gold's best friends.
Exactly. So the balance of those forces just result in range-bound trading for now.
Let's transition to policy and trade, because this is where long-term supply chain architecture is being rewritten in real time. We're getting massive signals from Washington on tech exports, specifically high-end chips.
This is one of the most critical developments for the global tech sector and for the U.S.-China relationship.
What's the signal?
The U.S. administration appears to be actively considering issuing export licenses that would allow NVIDIA's high-end H200 chips to be shipped to China. This would be a huge shift in their technology control objectives.
It sounds like an easing of policy, but what's the strategic balancing act here? It can't be simple.
Oh, the complexity is immense. The U.S. wants to maintain control over strategic computing power to prevent military applications.
But the American firms want market access.
Of course. We know the CEO of NVIDIA, Jensen Huang, confirmed he met with President Trump, and export controls were central to their talk. And crucially, Huang pointed out that U.S. firms can't just degrade chips for the Chinese market forever.
What does that mean in practical terms?
It means China requires a certain threshold of performance for its own AI and data center needs. If the U.S. restricts performance too much, Beijing will just accelerate its own internal development.
Or source from competitors.
Right. So the policy has to thread this very fine needle. Approve chips that meet commercial demand, but remain technically below the U.S. military threshold. It's an incredibly difficult equilibrium to maintain.
And this softening signal on technology seems to align with broader diplomatic efforts to preserve the fragile trade truce with China.
It does. We also saw the administration halt sanctions on China's intelligence agency. These shifting signals, combined with the technical complexity of the chip licenses, inject a lot of volatility into equity sentiment, especially for any company in high-performance computing.
Now, moving regionally, we can't ignore the major wildcard for North American supply chains, the United States-Mexico-Canada Agreement.
The USMCA. It remains a massive uncertainty factor. President Trump recently floated the idea of allowing the agreement to expire entirely.
Or just aggressively renegotiating it?
Right. And that threat alone creates immediate tremors in specific industries.
Which sectors are the most exposed to that kind of volatility?
Well, think about the automotive sector. Modern vehicles in North America rely on these complex, just-in-time supply chains that cross the borders multiple times.
Parts from Michigan to Mexico for assembly, back to Canada.
Exactly. A disruption or expiration of USMCA would instantly introduce tariffs and paralyzing uncertainty into that flow. It would force companies to rethink their entire regional manufacturing footprint.
A major economic headwind.
Huge. So whether it's high-end chips for China or the foundational trade agreement for North America, policy uncertainty is just driving enormous investment decisions right now.
Let's go back to geopolitics for a moment outside the U.S.-Russia dynamic. We're seeing some really unexpected shifts in global alignment.
The surprising move involves Venezuela. President Nicolas Maduro confirmed he had spoken with President Trump.
Really? What did he say?
He described the discussion as initial steps toward a more respectful dialogue. This is a significant pivot after years of intense hostility and sanctions.
So what does that mean for global markets, even if it is just initial dialogue?
Well, any softening of that relationship could potentially impact energy policy down the road. Venezuela holds massive oil reserves. We're a long way from seeing a material supply change.
Yeah.
But the shift signals that diplomatic channels are reopening, which adds another layer of complexity to the global oil market.
Okay. And meanwhile, tensions in the Middle East persist, even as economic talks try to surface.
That's the pattern in that region.
Yeah.
Israel and Lebanon recently engaged in some economic cooperation discussions using a long-established ceasefire monitoring channel.
What?
But Israel was explicit in stating that Hezbollah disarmament is a non-negotiable requirement for any significant long-term normalization.
So military and political preconditions are still rigidly in place.
Right, which ensures that region remains a flashpoint, even if there are small economic talks.
And while the U.S. and its partners navigate all this, China is actively reinforcing its own ties, particularly with France.
Yes, China and France made moves to strengthen their bilateral cooperation on multiple fronts. Multilateralism, airspace initiatives, nuclear energy, expanded two-way investment.
It demonstrates China's effort to solidify relationships with key European players, especially with its ongoing trade tensions with the U.S.
Absolutely. And on top of that, President Xi is signaling within China's next five-year blueprint a commitment to boosting domestic demand and increasing market access.
Which, if it happens, could fundamentally alter global trade flows.
By shifting their focus inward, yes.
So let's pull all this back to the overall risk tone. Despite this cocktail of uncertainty, the Fed drama, the USMCA threat, geopolitics, equity markets has stayed surprisingly constructive. Why is risk appetite holding up?
Equity sentiment is still broadly supported, and it's leveraging the advance from the previous U.S. session. A key bit of relief came when Microsoft specifically denied reports that its AI sales quotas were lower than expected.
So that denial allowed for a broader recovery in risk appetite across the whole tech sector.
It did. The structural enthusiasm for AI and tech growth is temporarily outweighing these policy risks.
And you're seeing that elsewhere.
Yes, we're seeing outperformance in cyclical sectors like energy and financials, which is often tied to improving risk appetite. This mood benefits from two factors we saw earlier this week: a weaker dollar and softer yields. So as Europe opens with gains, traders are, for the moment, willing to look past the drama.
But the risks haven't gone away. They're just being moderated by this enthusiasm.
That is the tension of the day. The core uncertainty, geopolitical hotspots, the domestic political drama around the Fed chair, it continues to act as a latent drag.
It's a balancing act.
It is. Traders are balancing these stabilizing but still soft dollar flows with very firm commodities led by copper and oil. The danger is that if the political uncertainty around the Federal Reserve were to spike,
Say, with a more concrete announcement.
the constructive equity mood could reverse instantly. It could trigger a significant flight to safety.
So navigating the markets right now, it isn't just about traditional economic indicators. It's about understanding how political calculus, whether it's in Washington over a trade deal or in Japan over a rate hike, translates directly into financial volatility.
It's a policy-driven market. It's a market where the smallest diplomatic signal about one piece of high-end hardware, like an NVIDIA chip, ends up impacting every corner of finance, from the yen's value to the physical price of copper. So that really wraps up our analysis on the stabilizing dollar flows, the copper surge, and all the persistent geopolitical uncertainty that's driving global sentiment today.
Yeah, it's clear the biggest risk might not be the economic data itself.
I think you're right. It's the political temptation to prioritize, short-term stimulus over that long-term institutional credibility.
A cost that could eventually redefine the dollar's role in the world. A powerful thought to end on.
It really is.
We appreciate you tuning in. Please join us again next time on the Financial Source Podcast.